October 28, 1929 was supposed to be just another Monday. Businessmen in Manhattan rode the subway to work, reading newspapers that declared American prosperity would last forever. Secretaries typed letters about record profits. Bankers counted deposits that seemed to multiply like magic. And across the nation, ordinary families planned vacations they could suddenly afford, bought cars on credit they thought was guaranteed, and watched their stock portfolios climb toward heaven. Nobody knew they were living through the final hours of the greatest economic illusion in American history. Nobody understood that the very confidence driving their wealth higher was the same force that would destroy it by Tuesday afternoon. The stock market crash of 1929 wasn't an accident. The 1929 crash was the inevitable conclusion of a decade-long experiment in financial fantasy. An entire nation had convinced itself that prosperity was permanent, debt was harmless, and the stock market could only rise. What really happened in those final hours reveals a pattern that repeats in every market crash since. But the real story isn't just what happened when the bubble burst. The real story is how confident, intelligent people talked themselves into believing that this time was different, that the old rules of economics no longer applied, and that the party would never end. Because the same delusion that destroyed fortunes in 1929 lives on in every bubble since. To understand the madness, you have to start with the madness that preceded it. The 1920s weren't just prosperous, they were intoxicating. America had emerged from World War I as a creditor to the world, its factories intact, its banks flushed with European gold. For the first time in the nation's history, ordinary workers could afford luxuries their grandparents had only dreamed of. Radios, automobiles, refrigerators, and washing machines rolled off assembly lines and into homes across the country. Henry Ford had perfected mass production, making cars affordable for the middle class. Thomas Edison's electric grid was lighting up cities from coast to coast, and consumer credit made it all possible, allowing families to buy now and pay later. But here's where the story gets dangerous. When people feel rich, they act rich, and when they act rich, markets respond by making them feel even richer. The stock market became the national obsession. Barbers gave stock tips between haircuts. Taxi drivers discussed their portfolios. Housewives pooled money to buy shares in companies they'd never heard of. The market wasn't just an investment, it was proof that America had discovered the secret to endless wealth. Between 1924 and 1929, the Dow Jones Industrial Average tripled. Stocks that cost $50 in the spring were worth $150 by fall, and everyone who bought early looked like a genius. The engine driving this prosperity was credit, not just personal credit for cars and appliances, but financial credit that let investors buy stocks with borrowed money. Brokers offered something called buying on margin, where you could purchase $100 worth of stock with only $10 of your own money. The broker would lend you the other $90 using the stock itself as collateral. If the stock rose, you kept all the profit. If it fell, well, nobody talked about that because stocks only went up. By 1929, margin buying had become so common that $6 billion in broker loans were outstanding. That's equivalent to over $90 billion today. All of it betting that the party would continue forever. The psychology was intoxicating and poisonous at the same time. Every success story reinforced the delusion. Joseph Kennedy, father of the future president, made millions speculating in stocks and real estate. Jesse Livermore became a folk hero for his ability to time the market perfectly. Ordinary people read about these titans and thought the same rules applied to them. Financial magazines published articles with titles like "Everybody Ought to Be Rich" and "The Permanent Plateau of Prosperity." Irving Fisher, one of the most respected economists in America, declared in October 1929 that stock prices had reached a permanently high plateau. Even the experts believed their own propaganda. But beneath the surface, cracks were already showing for those who cared to look. Corporate profits weren't growing fast enough to justify stock prices that had tripled in 5 years. Unemployment was creeping higher as companies automated production. Farm prices had been falling since the early 20s, crushing rural economies that politicians preferred to ignore. European nations, still recovering from the war, were struggling to repay debts to American banks, and the Federal Reserve, worried about speculation, had been raising interest rates to cool the market. Higher interest rates made borrowing more expensive, but they also made the bubble more fragile. When the cost of credit rises, highly leveraged bets become harder to sustain. The warning signs were everywhere, but they were drowned out by the noise of celebration. Radio shows celebrated the stock market like a sporting event. Newspapers printed daily stories of ordinary people who'd quit their jobs to trade stocks full-time. Department stores reported record sales as customers splurged on luxury goods, confident their portfolios would cover the bills. The entire economy had become dependent not just on consumption, but on the belief that consumption could expand forever. And that belief rested on one fragile assumption, that stock prices would never fall far enough to threaten the system holding them up. Here's what made the situation so dangerous by October 29. The stock market wasn't just a place where rich people gambled with spare money. It had become the foundation of middle-class wealth. Teachers, clerks, and factory workers had sunk their life savings into stocks, convinced they were investing in America's future. Banks had loaned billions against stock portfolios, treating volatile securities as if they were solid assets. Corporations had used their own stock as collateral for expansion loans, betting their growth on the market's continued rise. The entire financial system had become a house of cards, where each level supported the ones above it, and the cards were already starting to tremble. In September 1929, the market had begun showing signs of strain. Some stocks fell sharply before recovering. Margin calls started to increase as nervous brokers demanded more collateral from leveraged investors. Smart money began quietly moving to the sidelines, though few noticed because the overall trend was still upward. Roger Babson, a financial forecaster who'd been warning of trouble for months, repeated his prediction that a crash was coming soon. But his warnings were dismissed as the pessimism of a man who had missed the greatest bull market in history. By the final week of October, the market was running on fumes and false confidence. Professional traders could sense something was wrong, but they couldn't pinpoint exactly what or when it might snap. Individual investors remained convinced that any dip would be temporary, another buying opportunity in a market that rewarded faith with fortune. Brokers continued extending margin loans because the commissions were too profitable to refuse. Newspapers kept printing optimistic headlines because optimism sold papers better than warnings about systemic risk. The stage was set for catastrophe, but nobody wanted to believe it. On Sunday, October 27th, families across America went to church, read the financial pages over breakfast, and planned their week around the assumption that prosperity was permanent. Children played in suburban yards made possible by stock market gains. Parents discussed college funds that seemed to grow by themselves. And somewhere in the back of everyone's mind was the quiet confidence that they'd discovered something previous generations had missed, a way to get rich without risk, to build wealth without work, and to trust that markets would always reward faith with fortune. But by Monday morning, that faith would be tested in ways nobody could imagine. Monday morning dawned with an unsettling quiet on Wall Street. The usual bustle of traders and clerks felt different, charged with an electricity that veterans of the market recognized but couldn't quite name. It was the kind of tension that builds before a thunderstorm, when the air grows thick and animals sense danger that humans ignore. But most investors brushed off the feeling, attributing it to normal Monday morning jitters after a weekend of reading financial pages that still promised endless prosperity. The opening bell rang at 10 o'clock, and within minutes, the character of the market revealed itself. Prices didn't surge upward as they had for months. Instead, they wavered, uncertain, like a drunk man trying to find his balance. General Electric, which had been a darling of speculators, opened lower. Radio Corporation of America, the stock that had made more millionaires than any other, stumbled in early trading. United States Steel, the backbone of American industry, showed weakness that sent whispers through the trading floor. But this wasn't panic, not yet. Experienced traders had seen volatile openings before. The market was simply catching its breath after the spectacular gains of recent weeks. Smart money would step in, bargain hunters would emerge, and by afternoon, the familiar climb would resume. That was the script everyone expected, the pattern that had repeated itself dozens of times over the past 5 years: temporary weakness followed by renewed strength, doubt conquered by confidence, fear overwhelmed by greed. The problem was that the smart money wasn't stepping in, it was stepping out. While ordinary investors saw dips as buying opportunities, professional traders were quietly liquidating positions they'd held for years. They could read the subtle signs that amateurs missed: the way volume spiked on down moves, the reluctance of buyers to support falling prices, the growing desperation in margin calls that brokers were making with increasing frequency. The professionals understood something that the public didn't. In a leveraged market, confidence isn't just helpful, it's essential. And confidence was cracking. By noon, the weakness was impossible to ignore. Stocks that had opened down a few points were now down 10, 15, 20%. The ticker tape, which had chronicled so many triumphant rises, began to lag behind the flood of sell orders. Traders who had spent months celebrating paper profits watched them evaporate in real time. Margin calls, once rare enough to be noteworthy, became a constant drumbeat. Brokers demanded immediate payment from investors whose collateral was shrinking by the hour, and those investors, many of whom had borrowed against everything they owned, faced a terrible choice: find cash immediately or watch their positions get liquidated at whatever price the market would bear. The psychology of the crowd began to shift in ways that would have been impossible to predict just hours earlier. Investors who had been supremely confident at breakfast found themselves questioning everything by lunch. If General Electric could fall 20% in a morning, what other assumptions were wrong? If margin calls were wiping out neighbors and friends, how safe were their own leveraged positions? The market wasn't just a financial mechanism, it was a reflection of collective belief, and that belief was fracturing in real time. What made Monday's decline so devastating wasn't just the size of the losses, but their speed. In previous market corrections, prices had fallen gradually, giving investors time to adjust their thinking, raise capital, or find buyers for their holdings. But the combination of massive leverage and interconnected positions created a different dynamic. When one highly leveraged investor was forced to sell, it pushed prices lower, triggering margin calls for other leveraged investors, who were then forced to sell, pushing prices even lower. It was a cascade, each sale creating the conditions for more sales, each margin call generating new margin calls. The human drama playing out on trading floors across the country was brutal and immediate. Men who had considered themselves financial geniuses just days earlier watched their fortunes disappear in hours. Secretaries fielded frantic phone calls from investors begging for more time to meet margin requirements. Bank officers who had enthusiastically approved stock-backed loans in the morning were calculating potential losses by afternoon. And in offices, homes, and clubs across America, people were beginning to understand that the wealth they had counted on wasn't wealth at all, but borrowed confidence backed by borrowed money. The afternoon brought no relief. If anything, the selling intensified as the reality of the situation sank in. This wasn't a temporary correction, not a healthy pullback. This was a fundamental breakdown in the system that had created so much paper prosperity. Stock prices weren't just falling, they were collapsing toward levels that made margin loans impossible to sustain. Brokers who had been happy to lend 90 cents on every dollar of stock value were suddenly demanding immediate repayment. Banks that had treated stock portfolios as solid collateral were recognizing them as toxic assets that couldn't be valued with any confidence. The most telling sign of the crisis wasn't in the numbers on the ticker tape, but in the behavior of the people who understood markets best. Floor traders who had built their careers on quick reflexes and perfect timing were paralyzed by the speed of the decline. Brokers who had spent years encouraging clients to buy on margin were now desperately trying to reach those same clients to demand more collateral. Bank presidents who had celebrated the democratization of stock ownership were calculating how many depositors they might lose when margin calls couldn't be met. And as the closing bell approached, the extent of the damage was becoming clear. The Dow Jones Industrial Average had lost over 12% of its value in a single day. Individual stocks had fallen 20, 30, even 40%. Billions of dollars in paper wealth had simply vanished, not transferred to someone else, but destroyed by the recognition that it had never really existed in the first place. And yet, even as Monday's trading session ended, most investors still believed this was an aberration, a violent but temporary correction that would be followed by recovery. The newspapers that evening tried to strike a balance between acknowledging the day's losses and maintaining the confidence that had fueled the boom. Headlines spoke of a sharp break and heavy selling, but editorials insisted that the fundamental strength of American business remained intact. Histo-money experts quoted in evening editions suggested that the market had simply been due for a healthy correction after such spectacular gains. Political leaders issued statements about the soundness of the banking system and the resilience of the American economy. But in brokerage houses across the country, a different conversation was taking place. Margin clerks were working through the night, calculating how many clients would receive calls in the morning demanding immediate payment. Traders were reviewing their own positions, wondering which stocks would open lower and how far the decline might continue. And bank officers were quietly reassessing loan portfolios that looked solid on Friday but appeared dangerously exposed by Monday night. The real tragedy wasn't just financial, but psychological. Millions of Americans went to bed on Monday night with their first real taste of doubt about the system that had made them wealthy and secure. The market wasn't just an investment vehicle, it had become the foundation of their optimism about the future, their confidence in American capitalism, and their belief that prosperity was their birthright. When that foundation cracked on Monday, it didn't just threaten their money. It threatened their entire understanding of how the world worked. Tuesday morning would bring answers to questions that nobody wanted to ask. How far could prices fall? How many margin calls could the system absorb? How much borrowed confidence could evaporate before the entire structure collapsed? But as Monday night settled over a shaken nation, those answers still lay hidden in the darkness, waiting for the opening bell to reveal the true cost of believing that prosperity could be built on nothing more than faith and borrowed money. Tuesday morning arrived like a funeral procession. The sun rose over Manhattan just as it had every day for centuries, but the city that awakened beneath it was fundamentally different from the one that had gone to sleep. Across America, investors who had tossed and turned through the night reached for their morning papers with trembling hands, hoping to find reassurance that Monday's collapse had been a nightmare from which they could still wake up. Instead, they found headlines that confirmed their worst fears and hinted at terrors they hadn't yet imagined. The pre-market indicators were catastrophic. Overnight, European markets had plummeted in sympathy with New York's decline, creating a global wave of selling that was now racing back across the Atlantic like a financial tsunami. London had closed sharply. Paris had suffered its worst day in decades, and in the early hours of Tuesday morning, as American brokers tallied the overnight orders that had poured in from panicked investors, it became clear that Monday's 12% decline was not the end of the crisis. It was merely the opening act. The human cost of Monday's collapse was already becoming visible in ways that stock charts couldn't capture. Across the country, families sat around breakfast tables in stunned silence, confronting the reality that their children's college funds had evaporated overnight. Middle-aged workers calculated how many years they'd need to rebuild retirement savings that had taken decades to accumulate. Small business owners who had used stock portfolios as collateral for expansion loans faced the prospect of bankruptcy before the week was over. The American dream hadn't just been delayed. For millions of families, it had been obliterated. But the most dangerous element wasn't the losses that had already occurred. It was the web of interconnected obligations that those losses had set in motion. Banks that had loaned billions against stock portfolios were now holding collateral worth a fraction of the outstanding debt. Insurance companies that had invested policyholder premiums in the market faced potential insolvency. Corporations that had used their own stock to secure credit lines were discovering that their access to capital had vanished along with their share prices. The entire financial system was discovering that prosperity built on borrowed confidence could collapse faster than anyone had thought possible. The psychology of Tuesday morning was unlike anything America had experienced for a generation. For the first time in a generation, the fundamental assumption that markets rewarded optimism with profits had been shattered. Investors who had spent years believing that every dip was a buying opportunity were now terrified that every rally was a trap. The mental framework that had guided financial decisions for nearly a decade had become not just useless, but dangerous. Confidence, which had been the engine of prosperity, was now the enemy of survival. When the opening bell rang at 10 o'clock on Tuesday, October 29th, the selling began immediately and intensely. There was no period of hesitation, no moment of doubt, no pause for reflection. Orders to sell poured onto the trading floor like water through a broken dam. General Motors, which had symbolized American industrial might, opened down 20 points. Westinghouse Electric, the company that had electrified the nation, fell 30 points in the first hour. Radio Corporation of America, the stock that had created more fortunes than any other, collapsed so quickly the traders couldn't keep up with the price changes. The ticker tape, which had been the scorecard of American prosperity, became an instrument of torture. It fell further and further behind the actual trading, creating a surreal situation where investors couldn't even know how much money they were losing in real time. The delay between trades and their appearance on the tape meant that by the time investors saw a price, it was already obsolete, replaced by something even worse. It was like trying to navigate a sinking ship with a compass that showed yesterday's position. The volume of selling was unlike anything the New York Stock Exchange had ever handled. Trading that normally processed 3 million shares in a busy day was attempting to process 16 million shares, overwhelming systems that had been designed for a gentler, more civilized market. Floor traders, accustomed to the choreographed dance of professional buying and selling, found themselves caught in a stampede. Orders came in faster than they could be executed, prices fell faster than they could be recorded, and the machinery of American finance, which had seemed so sophisticated and modern just days earlier, revealed itself to be fragile and inadequate when tested by genuine panic. The human drama on the trading floor was both heroic and heartbreaking. Clerks worked with desperate efficiency, trying to process sell orders that represented the life savings of people they'd never meet. Traders who had built their reputations on cool professionalism found themselves shouting to be heard above the chaos. Phone operators fielded calls from investors who pleaded, threatened, and begged for information about positions that were dissolving by the minute. And in the galleries above the trading floor, spectators who had come to witness the excitement of American capitalism instead watched the destruction of everything they had believed about money, markets, and the future. The cascade of margin calls that had begun on Monday became an avalanche on Tuesday. Investors who had borrowed heavily to buy stocks were receiving demands for immediate payment that they couldn't possibly meet. Many had already exhausted their savings trying to meet Monday's calls. Others had borrowed against homes, businesses, and life insurance policies to maintain their positions. By Tuesday afternoon, brokers were liquidating accounts without waiting for permission, selling stocks at whatever price they could get to recover loans that had become hopelessly underwater. The psychological impact of these forced sales was devastating and self-perpetuating. Each liquidation pushed prices lower, which triggered more margin calls, which forced more liquidations, which pushed prices even lower. It was a death spiral that fed on itself, growing more destructive with each turn. Investors who might have held their positions through a normal correction were forced to sell at the worst possible moment, not by choice, but by the mathematical reality of borrowed money in a falling market. Banks across the country were facing a crisis that their executives had never imagined possible. Loans that had seemed conservative when backed by blue-chip stocks were now secured by assets worth half their original value. Depositors who had entrusted their savings to institutions they believed were rock solid were beginning to question whether their money was safe. And bank officers who had spent years approving stock-backed loans with confidence were now calculating potential losses that could wipe out capital accumulated over decades. The ripple effects extended far beyond Wall Street. Small towns across America were discovering that their local banks had invested heavily in the stock market, either directly or through loans to investors. Main Street businesses that had counted on credit from those banks were finding that money was suddenly unavailable. Farmers who had borrowed against expected crop revenues were facing demands for immediate repayment. The financial crisis was metastasizing from a stock market problem to a banking problem, from a banking problem to a credit problem, and from a credit problem to an economic catastrophe that would touch every corner of American life. By midday Tuesday, something unprecedented was happening. The most powerful financiers in America were meeting in emergency session, not to profit from the crisis, but to prevent the complete collapse of the financial system. J.P. Morgan Jr., Thomas Lamont, and other banking titans gathered to coordinate a response that they hoped might stabilize the market before it destroyed everything they had spent their lives building. But even their vast resources seemed insignificant compared to the magnitude of the selling pressure that was overwhelming every attempt to establish a floor under prices. The irony was cruel and complete. The same leverage that multiplied gains on the way up was now multiplying losses on the way down. The same confidence that drove prices to unsustainable heights was creating panic that drove them to equally unsustainable lows. And the same democratization of stock ownership that made millions of Americans feel wealthy was making those same millions feel betrayed by a system they had trusted with their futures. As Tuesday afternoon wore on, the scope of the disaster became impossible to deny. This wasn't a correction, not a healthy pullback, not a temporary setback in an otherwise sound market. This was the collapse of a financial structure that had been built on borrowed money, borrowed time, and borrowed confidence. The party that seemed like it would last forever ended not with a gentle fade, but with a crash that would echo through generations. The 29th of October 1929 wasn't just a date on a calendar, it was the moment when an entire nation discovered that prosperity built on borrowed confidence isn't prosperity at all. It's a beautiful, dangerous illusion that can evaporate faster than the paper it was printed on. The families who went to bed wealthy on Sunday and woke up ruined by Wednesday learned what every generation must learn again: that markets don't reward faith with fortune forever, and that the higher the bubble rises, the more devastating its collapse. But here's the lesson that matters most. The crash of 1929 wasn't a historical accident or a unique failure of an innocent time. It was the inevitable result of believing that this time was different, that old rules no longer applied, and that prosperity could be built on nothing more than optimism and leverage. Those same delusions live on in every bubble since, wearing new clothes but telling the same lies. And when the next crash comes, it will destroy those who trust the system most and reward those who understand that confidence without substance isn't wealth, it's simply confidence waiting to be shattered. History doesn't repeat, but if you ignore its warnings, it will crush you all the same. If this gave you a new perspective, hit subscribe.